This is Henry Gamble with SimplerOptions.com, and in tonight's free video, I wanted to share a couple of things with you that I'm focusing on into the monthly expiration. So, of course, with this being Monday, it is the content that we'll be using to head into Tuesday that tells us that we have 4 days of life left for the existing monthly contracts, and it's really a time where some people approach it from the perspective of saying that trading this close to expiration doesn't give you enough time to let your ideas work out. I will take the other side of that argument and say that if you're willing to make sure you have your risks defined and work spreads into the day of expiration, I think there's a ton of opportunity around it. I'm going to show you 2 places that we've been working this in the chat room, and then give you one that you can work on your own into Friday if you would like. The first that we're going to take a look at is Tesla. And Tesla is interesting to me because after the earnings report, it traded pretty rough in the after hours session. It's not shown on this chart, of course, because this is a daily without that information shown, but it did have a pretty rough sell-off, but then during the day had a miraculous comeback, traded up here into the 200-day moving average, and has since failed. The way I look at this chart is, to me, that starts to prove that there's pretty decent support back down here at 200. Now, of course, at any time these levels can break, of course, but generally speaking, it's a good area of psychology. It's a good level where price has proven itself, and if it's able to hold that after the earnings announcement they had, I'm going to give it a little bit of credibility. Then on the flip side of that, of course, the 200-day moving average is good resistance. These are also your 20-day price channels where it is stalled out, and it just starts to create a range. So what we were looking at was right back in here is after you've identified the range, when you're trading in the dead middle of it, in this case that was $215, that gives you a very even balance being between, essentially $15 from 230 and then $15 away from 200. This is where you start to have opportunities where you can do things like an iron butterfly. These are not really complicated strategies once you put them on a few times, and the main thing I like about them is how forgiving they can be. The first position we've put on, we put it on essentially right at 215, so rallying back into 215 is going to leave us pretty much centered in between the two. The only thing that we've really made money here off of was the time decay, and that's exactly what you're looking for in a monthly expiration. I also had a couple more that I've legged into, and if you can do that, kind of opposing to what you might think. So sell the calls when it's strong, sell the puts when it's weak, and then when they can meet back in the middle, that's where that strategy will come to work out for you. So that's what we've been doing in Tesla, and it's been working out pretty well. Another is IBB, and it illustrates the exact same concept. Now, I'm not going to get as detailed with this one, but it's exactly the same idea, basing it off the idea that you're trading at 325, so support at the psychological level of 300, and then overhead resistance at the 200-day moving average at 350. With stuff like this, I much prefer to see people widen out their wings and lower their size. This gives you a higher range to have a profit. I think it makes it much easier to manage, and it really helps take advantage of what would be the at-the-money straddle. So there's 2 examples of where we've been putting them on, and they've been working great. The third, where I have no positions, but I am looking at the idea, is here in Under Armour. So as we start looking at the daily chart, you can see that we've come down into the 200-day moving average, held, and had a really nice reversal today, up about 3%. Part of what caught my eye on this one is you've got price that closed exactly at $90, and then if you take a look at an options chain, the movement into the week, they're expecting about almost a $4 move. To apply the exact same concepts in here, you can start by right-clicking and selling an iron Condor. Once you've got this much of the trade configured, by starting on the call side, the $90 call is already in the correct position. We just need to widen out our wings for the protection strike, which I'm going to do $5 wide here, and then adjust the puts to move up 1. That step right there is what changes you from an iron Condor into an iron butterfly, just sharing that short strike, of course being on the opposing put and call side. We move out the put to make this balanced, exactly the same way we've done it back up in here. And the thing that I like pointing out with these strategies is that if you can get this trade for $2.70, then all you have to do is be $2.70 within 90, the price that you are short, for this trade to make a profit. So it's giving you about $3 of wiggle room. You've got about that expected move into the end of the week, and if you're looking for something that you don't have to focus on direction, you can let theta decay be your biggest asset, these are the places that I will look into expiration. So I hope that helps. You guys have a great rest of your week, and I will see you on the next Monday night free video.